In this video, I want to share a mind-boggling statistic showing that most people that do day trading lose money. 80% of people that do day trade lose money, and why that's the case. Talking about day trading, I think is so important because there are so many people on YouTube, on Reddit, promoting day trading, telling how much money you can make and what a good strategy it is. And I want to debunk some of these topics. I hope with this video I can convince a few people not to do day trading and to not lose money. I myself have been very active in the stock market. I've been investing since 2010, over 10 years. Averagely, I've had a return of a little over 10%, but I'm honest to myself. I know that it's not because I'm the smartest person in the room and that I've done incredible investments. It's because the overall market has increased a lot and has gone up by 10% average over the past 10 years. So I've been going up with the market, but I haven't been beating the market at all. And I strongly believe that you also won't be able to actually beat the market. And I want to start off by looking at a crazy statistic that proves the point that it's so hard to make money day trading. To me, day trading is the opposite of long-term investing. Day trading is more short-term bets. Holding positions only for a day. Could be a couple days, but it's typically not holding a position for half a year, 2 years, 3 years. So it's buying, selling within a day or over a couple of days. Most day traders also use leveraged positions. So either they buy leveraged instruments like options, leveraged derivatives, or they leverage their whole account. They buy on margin. Basically, they put in 50% equity and 50% is debt. Certain brokerages like Robinhood, etc. allow that, and that is also a highly risky instrument that is typical for day traders. And now let's look at a quick statistic that hopefully proves the point to you that day trading is so hard and it's so hard to actually make money with it. I went on curiousgnu.com/day-trading. He did an amazing job analyzing data from eToro, a brokerage company that is primarily active in Europe. And so the data he used is from users in the UK, Germany, etc. And I'm gonna share the link in the description of this video. But let's look at this amazing chart. This chart shows you on the horizontal axis all the users plotted based on how much they've gained in their portfolio over the past 12 months. So all the way to the right, 200% is a 200% gain. All the way to the left is a 100% loss, meaning they've lost all of their money. And on the vertical axis, you see the number of people, the number of real money traders that have achieved this particular return in the past 12 months. So for instance, if you go here all the way to the left, there have been around 4,000 traders that have lost more than 90%, 91% of their money. And here in the middle, there have been almost 6,000 traders that have made between 0 and -3%. And what are a couple interesting insights here is there aren't really that many people that make a lot of money. All the way here, everything to the right of the 0, these traders have made money over the last 12 months. And all the traders to the left have lost money. And you can clearly see that the left is way bigger than the right-hand side. And that's an important takeaway, that most people will actually end up on the left-hand side losing money. And not that many people will make money and end up on the right-hand side. Now looking at the specific numbers. If you actually go here from the 0 all the way to the left and add up all the traders divided with the total number of traders, you'll get to around 80%. I think it's around 79%. Saying this whole chunk of traders, 80% of traders have lost money over the last 12 months. And that's where the statistic comes from, that 80% of day traders lose money. And so 8 out of 10, that's a big number. And the median person, so that the 50% person in the middle, lost 40%. That's a lot of money. And there have even been a decent amount of people that lost more than 90% of their portfolio. So the takeaway is from this analysis, it's really hard to make money day trading. We just looked at actual trading data from eToro, a brokerage company in Europe, and we saw that 80% of traders lose money. Why is that the case? What's the cause of that, of most people losing money? The main reasons can be categorized into 3 buckets. Number 1, behavioral. Second one, costs and fees. And the last one, opponents or competitors. Starting with the first one, behavioral. Behavioral economics and behavioral researchers have found out a couple mistakes, behavioral mistakes that traders typically make. And one of them is selling winners too early and holding on to losers for too long. It's also called prospect theory. And what it says is, if your stocks go down 10% in value, as opposed to going 10% up in value, the 10% loss hurts us way more than the 10% gain gives us pleasure or makes us happy. When our stocks go up 10% in value, we think, oh great, we celebrate ourselves and we want to cash in. We want to realize the win, so we can say, oh, I've actually made 10% on that trade, as opposed to holding it for longer and potentially making 20-30%. The opposite happens with losers. If a trade goes down 10% or the value goes down 10%, we tend to hold on. We tell ourselves, oh, it's gonna turn around, it's gonna pivot. Let's just keep it for a couple more hours, couple more days, and it goes down 20%, 30%. But then we still don't want to accept the fact that we made a bad trade. And this leads to a situation where people tend to keep losers for too long. They always hope, they hope a little bit of it turning around instead of cutting their losses and staying with the winners. Another behavioral mistake is leveraging your portfolio, using leverage by buying options or leveraging your whole portfolio. And by already having an average negative return, by leveraging that return, you multiply that return and make it even worse. Leverage obviously goes both ways. If on average you make money, using leverage is helpful because it multiplies your positive return. But if on average your expected return is negative, which we've shown in the previous section that 80% of traders lose money, by leveraging that, your expected return will go down even further. And the second point I want to talk about is fees and costs. Number 1, traditional fees you have to pay and costs you have to pay are trading fees when you buy and sell a transaction, even though they have come down over time and some brokers nowadays don't charge anything. There are still fees and commissions that affect you over time. For instance, Robinhood is front running the trades, meaning they give you a little bit worse of a trade or of a price when you buy through them. And a lot of other companies sell your trades to other high frequency traders so they can pocket a little bit of a difference before they give the trade to you. And lastly, your competition, your opponents. Since on average the market is all participants combined, if on average the S&P goes up 10%, by day trading you're trying to beat the market. And you're trying to beat other really powerful players. You're playing against the big boys, against Wall Street banks, hedge funds with millions of dollars in research money, in people employed, and just looking at ways to make money in the market. By day trading, you're basically saying, I'm better than those guys. I'm able to beat them. And that's really, really hard. I hope this video was helpful. Please let me know your thoughts in the comment section, and I hope to see you in the next video.